We've all heard it: diversify, diversify, diversify. It's the mantra whispered in every investment seminar, preached from every financial blog, and etched into the very foundations of modern portfolio theory. But what if I told you that this sacred cow of investing, this seemingly infallible strategy, could be silently eroding your returns? What if the very thing you believe is protecting you is, in reality, setting you up for disappointment? This isn't about reckless speculation or chasing fleeting trends. This is about looking beneath the surface of conventional wisdom and asking a fundamental question: is your diversified portfolio truly diversified, or is it a cleverly disguised illusion? Are you spreading your investments, or are you simply diluting your potential for meaningful wealth creation? The truth often is uncomfortable. It challenges our assumptions and forces us to confront the possibility that what we thought was safe and sound may, in fact, be a significant risk. We're not here to blindly accept the status quo. We're here to dissect, analyze, and ultimately understand the *Y* behind every investment decision. Benjamin Graham, the father of value investing, wisely said that the underlying principles of sound investment should not alter from decade to decade, but the application of these principles must be adapted to significant changes in the financial environment. And the financial environment today is anything but simple. It's a complex web of interconnected markets, manipulated narratives, and hidden risks. So, what are we going to do? We are going to challenge the consensus. We are uncovering the hidden truths behind wealth accumulation. We're going to examine diversification strategies with a critical eye, exposing their hidden flaws and ultimately empowering you to build a portfolio that truly reflects your goals and risk tolerance. Are you ready to see beyond the headlines, to understand what's really driving the market, and to discover the shocking truth about your diversified portfolio? The bedrock of diversification rests on a simple premise: spreading your investments across assets that move independently of each other. The idea is elegant: when one asset stumbles, another rises, cushioning the blow and smoothing out your overall returns. But what happens when the seemingly independent pieces of your portfolio start dancing to the same tune? What happens when correlation, that critical measure of interdependence, becomes a cruel deceiver? The illusion of independence is perhaps the most dangerous trap in modern portfolio construction. We are lulled into a false sense of security by the sheer number of holdings, convinced that we've adequately mitigated risk. But history teaches us a different lesson. During times of crisis, correlations tend to converge toward one. The 2008 financial crisis, the COVID-19 pandemic, these events exposed the fragility of so-called diversified portfolios as seemingly unrelated assets plummeted in unison. This phenomenon, known as correlation clustering, reveals the hidden dependencies that lurk beneath the surface. Certain sectors, like technology and consumer discretionary, often move in lockstep, driven by similar economic forces and investor sentiment. A portfolio heavily weighted in these seemingly diverse areas can suffer significant losses when the tide turns. So, what can you do? Don't just invest. Understand the *Y* behind every decision. Challenge the consensus. Find your edge. One actionable step is to employ rolling correlation analysis. By examining how correlations change over time, you can identify hidden dependencies and proactively adjust your portfolio allocations. Are you truly diversified, or are you simply exposed to a concentrated risk factor masquerading as safety? It's time to peel back the layers of the diversification delusion and uncover the truth. There's a point where diversification ceases to be a virtue and morphs into a vice. It's the point where adding more assets to your portfolio doesn't meaningfully reduce risk, but actively diminishes your potential for returns. This is the realm of diworsification, a term coined to describe the insidious effect of spreading yourself too thin. What drives investors down this path? Often, it's a cocktail of cognitive biases: the fear of missing out, that nagging sense that you need to be in every hot stock or emerging market, can lead to impulsive decisions and a bloated portfolio. The illusion of control, the belief that you can somehow manage the complexities of hundreds of different investments, further fuels this behavior. And, let's be honest, there's a certain social pressure to look diversified, to appear sophisticated and in control. Think of it as watering down a fine wine. A few drops of water might make it more palatable, but too much will ruin the flavor entirely. Similarly, spreading your capital across too many assets dilutes the impact of your high-performing investments. A portfolio with hundreds of tiny positions might sound impressive, but each holding contributes negligibly to your overall returns, while adding layers of complexity and transaction costs. The antidote to diversification is focus. Instead of chasing fleeting trends and accumulating a laundry list of stocks, consider a concentrated portfolio of high-conviction investments. Base your decisions on thorough due diligence, a deep understanding of the businesses you own, and a long-term perspective. Don't just invest, understand the why behind every decision. Are you building a portfolio or simply assembling a museum of mediocrity? It's time to embrace the power of concentration and unlock the true potential of your capital. Beyond the illusion of reduced risk and the trap of diversification, there lurk hidden costs that can silently sabotage your returns. These are the insidious fees, taxes, and opportunity costs that often go unnoticed in the pursuit of diversification. Managing a larger number of positions inevitably leads to higher transaction costs. Every buy and sell order incurs brokerage fees, and these seemingly small amounts can add up significantly over time, especially in a high-turnover portfolio. Diversified funds and ETFs, while offering instant diversification, come with their own set of expenses. Management fees. These fees, often expressed as a percentage of assets under management, can erode your returns year after year, particularly if the fund underperforms its benchmark. Frequent trading, a common characteristic of diversified portfolios, also triggers tax liabilities. Capital gains taxes can diminish your long-term wealth, especially if you're constantly churning your portfolio in response to short-term market fluctuations. Perhaps the most overlooked cost of diversification is the opportunity cost. By allocating capital to underperforming assets in the name of diversification, you're missing out on the potential returns you could have earned by investing in your highest conviction ideas. So, what can you do? Don't just invest. Understand the why behind every decision. Optimize your portfolio turnover to minimize transaction costs and tax liabilities. Consider utilizing tax-advantaged accounts for your long-term investments. Are you aware of the hidden costs eroding your wealth? It's time to take a closer look at the fine print and reclaim control of your financial destiny. You entrust your capital to an actively managed fund, believing that the fund manager's expertise will generate superior returns. But what if that fund is merely a shadow of the index it's supposed to beat? What if your actively managed portfolio is, in reality, a closet indexer, charging higher fees without delivering any discernible alpha? This is the index-hugging illusion, a pervasive problem in the investment management industry. Diversification, ironically, can incentivize fund managers to become closet indexers. By closely mimicking the performance of a benchmark index, they reduce tracking error, the deviation of the fund's returns from the index, and minimize career risk. After all, it's safer to underperform slightly than to deviate significantly and risk losing clients. Data reveals the uncomfortable truth. Closet indexing is rampant. Many diversified funds exhibit high diversification and low active share, a measure of how much a fund's portfolio differs from its benchmark. These funds, despite their higher fees, are essentially replicating the index, offering little to no value to investors. So, how can you avoid this trap? Don't just invest. Understand the why behind every decision. Analyze a fund's active share and tracking error. A truly active manager will have a high active share and a willingness to deviate from the index in pursuit of superior returns. Are you paying for active management or simply subsidizing mediocrity? It's time to demand transparency and hold fund managers accountable for delivering genuine value. We've exposed the cracks in the foundation of traditional diversification, revealing its hidden flaws and potential pitfalls. But this isn't about abandoning diversification altogether. It's about evolving beyond conventional wisdom and seeking true resilience through alternative strategies. Traditional diversification, while offering some protection against idiosyncratic risk, often fails to shield portfolios from systemic shocks. When the entire market plunges, correlations converge, and even the most diversified portfolios can suffer significant losses. The key lies in expanding your horizons beyond traditional asset classes. Consider investing in uncorrelated assets like real estate, infrastructure, commodities, or private equity. These alternative investments can provide a valuable source of diversification, offering returns that are less dependent on the movements of the stock and bond markets. Geographic diversification is equally crucial. Reducing your exposure to specific economic or political risks can enhance the resilience of your portfolio. Explore opportunities in emerging markets and developed economies alike, but always conduct thorough due diligence. Risk management techniques such as option strategies, dynamic hedging, and tail risk protection can also play a vital role in safeguarding your portfolio against extreme market events. Ultimately, building a truly resilient portfolio requires a holistic approach. It's about striking a delicate balance between diversification and concentration, active management and passive indexing, and traditional assets and alternative investments. Don't just invest, understand the why behind every decision. Are you passively accepting conventional wisdom, or are you actively constructing a portfolio that reflects your unique goals and risk tolerance? It's time to embrace a more sophisticated approach to diversification and build a portfolio that can withstand the test of time. We've journeyed into the heart of diversification, exposing its hidden complexities and challenging the conventional wisdom that often surrounds it. We've seen how the illusion of independence can mask underlying correlations, how diversification can dilute returns, and how hidden costs can erode wealth. We've also uncovered the reality of closet indexing and the limitations of traditional diversification in the face of systemic risk. The key takeaway isn't to abandon diversification entirely, but to approach it with a healthy dose of skepticism and a commitment to informed decision-making. It's about moving beyond blind faith and embracing critical thinking and independent analysis. Now is the time to reassess your own diversification strategies. Take a hard look at your portfolio, examining its underlying correlations, its exposure to hidden risks, and its overall cost structure. Make informed adjustments based on your individual risk tolerance and investment goals. Don't just follow the herd. Forge your own path, guided by data, analysis, and a deep understanding of the businesses you own. Warren Buffett famously said that wide diversification is only required when investors do not understand what they are doing. This video has been a step towards the deeper understanding, a journey to demystify the complexities of portfolio construction and empower you to make truly informed decisions. Challenge the consensus. Find your edge. Don't just invest. Understand the why behind every decision. Are you ready to move beyond the diversification delusion and build a portfolio that truly reflects your knowledge, your conviction, and your aspirations? The power is in your hands. What will you do with it?